we are discussing about the derivatives market. In the previous class, we discussed about the different type of instruments which are available in the derivatives market, and as well as what is the use of the derivatives. And we started the discussion on the pricing of the derivatives, and here also we discussed about the concept of moneyness and as well as the intrinsic value and as well as the time value of the option premium. Today, we will be discussing about the different models which are used for the option pricing or the calculation of the option premium. So, if you see that in popular sense, there are two popular models which are used for pricing the options. One is your binomial tree model, then we have the famous the Black-Scholes model. So, these are the two popular models which are used for pricing the options. And one by one we will see that how these models basically work whenever we try to calculate the pricing of the options. So, let us see that what this binomial tree model is all about. Binomial tree model was proposed by Cox, Rose and Rubinstein in 1979, and here what are the assumptions what this binomial tree model always takes, that the asset prices follows a random walk and there is no arbitrage opportunity exists in the market. What do you mean by the random walk? That means here we are assuming that any kind of information which is coming to the market which drives the price of this particular underlying asset, that basically is random. So, that is a prediction of the prices using the past data is not possible. That means, if you are able to use the past information or past data by to predict this future, then we can say that that particular data series is not following the random walk. But here we are assuming that the assets, whether the asset can be stock, it can be bond, it can be any other asset, that basically follow a random walk and there is no arbitrage opportunity exist in the market. What do you mean by the arbitrage opportunity? Here we are talking about arbitrage opportunity means the law of one price, the law of one price should hold good. So, law of one price, how to define the law of one price? That price of a particular asset should be same in two different markets at a particular point of time. So, if there is a price differences, then the investor can always create the arbitrage opportunity or they can generate some riskless profit. That means, in one market they can buy this particular asset with a lower price and at the same time they can take a reverse position in other market. By that, without any risk, they can create certain return in the market segment. So, that is why we are assuming that the law of one price also holds good. That means, there is no arbitrage opportunity exist in the market and as well as the underlying assets basically is following the random walk. So, these are the major assumptions what the binomial tree model takes, and now we will see that how this particular model works. Here if you see that whenever we go for the binomial tree model, we try to construct a portfolio, and because our basic objective is to hedge the risk and we try to take the position or try to compose our portfolio in such a way, by that the total risk in the market can be hedged out. So, here what basically we are assuming, we are basically having a portfolio where we have taken a long position in the spot market and we have taken a short position in the option. That means, we are going by the, we are buying the delta amount of stocks. Here we are underlying asset, we have taken the stocks, then we are selling the options which are based upon this particular stocks. That is why the short position we are taking for the options and the long positions we are taking on the stocks. And you assume the current market price or the market value of the stock is S. and the current price of the option on that particular stock is let F. So, our objective is to find out the F, and also we are assuming the option is going to be matured at the time t, and during the life of the option the value of the underlying the stock may go up to SU or it can goes down to ST. So, either it can go up to SU or it can go up to SD. U means it is increasing, D means it is declining. So, then the percentage increase in the stock price when it moves up is U minus 1, because it is increasing, that means it is more than 100%. So, here your U is greater than 1, and the percentage decrease in the stock price when it is comes down it is 1 minus D, because D is less than 1. And here we are expecting a payoff from the option whenever the price is going up, that is FU, and whenever the price is going down, that is SU. So, here if the stock price become SU, we are finding this option price is FU and the payoff is FD when the prices move down to ST. So, these are the notations what we are going to use. So, if I will explain in this way, the price was S, it can go up to SU or it can go down to ST. So, here is the F that we are trying to find out. So, whenever it is going towards SU, the payoff will be F of U, FU, and whenever it is going down to SD, the payoff will be FT. So, now using these notations we have to see how that option prices can be or option price can be calculated from this. So, now if you see using these notations, what basically our objective? We need to calculate the value of the delta. We need to calculate the value of the delta which makes our portfolio riskless. That means, we have to generate certain kind of return out of this, which is nothing but the risk free rate of return on the particular from this particular portfolio. If the stock price goes up, then the payoff from the portfolio will be S d delta minus F of D, and if the price of the stocks move down, then the payoff from the portfolio will be U delta minus F of U. So, then the two payoff, if you want to make it equal, then what basically you can find out? S U delta minus F of U is equal to S d delta minus F of D. So, now if you solve this equation, your delta will be F of U minus F of D. That means, your S U delta basically it is S U delta, your S U delta minus F of U is equal to S d delta minus F of D. So, in both the conditions basically that should be equal. If that is equal, then what basically you can find out, here your delta is equal to F of U minus F of D is equal to divided by S U minus S D. That means, we want to make this particular portfolio which is riskless, and we want to generate certain kind of return out of this, which is basically your risk free rate of return. Here basically you see, if the stock prices goes up or down, depending upon that the delta value will be changed. One thing here, here if you observe, if the stock prices goes up, the payoff from the portfolio will be S. Here basically it is you can make it goes down, there is a mistake here and it is moves up. If the stock prices goes up, then payoff will be then payoff will be S U delta minus F of U. Whenever it is goes down, the payoff will be S d delta minus F of D. So, there is some typo error here. So, it is goes down and it is goes and moves up. So, that is the changes what basically I am requesting you to make. So, now we have S u delta minus f of u is equal to S d delta minus f of d, that equality has to be maintained, and here we are, our objective is to find out the delta value. Then delta is equal to your f of u minus f of d divided by S u minus S t, and what is then delta? The delta is nothing but the ratio of change in the option prices to the change in the value of the stock. So, let us take a numerical example to understand that how that particular delta value can be calculated. So, if you before going for this numerical example, for example, the portfolio is risk free, already we have taken, there is no arbitrage opportunity, that assumption we have taken. Then the portfolio must earn the risk free rate of return R if invested for time t. So, then the present value if you want to calculate, then what basically you can calculate in different conditions, that is your, because this is the payoff what basically you are getting, that is S u delta minus f of u. Then if you want to find out the value after the time t and your R is equal to your rate of return, then it is basically that already you know that S u delta minus f of u into e to the power minus R t. And what is the cost of the portfolio? The cost of the portfolio is basically how much money we have spent on that particular stock. So, that is why it is delta amount of the stock multiplied by the price of the stock minus the premium whatever we have paid. So, now if the particular portfolio is risk neutral, then what basically you can see that S delta minus f is equal to S u delta minus f u e to the power minus R t, if it is a risk neutral portfolio. Then what you can do? You can already you know the what is the delta, delta is equal to f of u minus f of d divided by S u minus S d. You can put that particular value here, then you can find out f is equal to f u 1 minus d e to the power minus R t plus f d into u e to the power minus R t minus 1 divided by u minus d. Then obviously, your f is equal to e to the power minus R t p of f u plus 1 minus p f of d. This p and 1 minus p basically shows the probability of increase of the price and probability of decreasing the price. The total probability is 1, p is basically shows you the increase and 1 minus p shows you the decrease. Then here the p, how the p is calculated? The p is nothing but p is equal to e to the power R t minus d divided by u minus d. So, now this is what basically we try to find out, that f is equal to e to the power minus R t p f u plus 1 minus p f d. So, now we will see that how basically it works. This is the example what you can take. Let that is the current price of the stock is 30 rupees, and it is known that at the end of 3 months it will be either 33 or it will be 27. The strike price of the call option is 31. After 3 months, if the stock price turns out to be 33, the value of the option will be 1 rupees. If the stock price turns out to be 27, then the value of the option will be 0. That means, the option will not be exercised, because it will be less than the call option. The risk free rate of return is 10%. Then here find out the value of the call option, that is the question. So, your S of stock price in the beginning is 30, t is equal to 3 months, that means 0.25 years, f of u is equal to 1 if the price goes up to 33, and f of d is equal to 0 obviously if the price goes down to 27. So, then your u will become 1.1 and your d become 0.9. So, now what basically you can find out? You can use that equation, and that equation if you use, then you can find out p is equal to e to the power 0.1 into 0.25 minus 0.9 divided by 1.1 minus 0.9, that is 0.626. So, the P basically you got, if the P you got, then you can find out your 1 minus P, then 1 minus P is equal to 1 minus 0.626, that will become basically you will find out the 1 minus P values. So, now you can what you can do this in this equation you have the f is equal to e to the power minus r t into P into f of u plus 1 minus P into f of d. Then f of d is equal to 0, then obviously your 0.626 into 1 plus 1 minus 0.626 into 0, that you got it 0.6111. So, the option premium of the option price of this particular example will be 0.611. So, you can have also two stage model, further again it can go up to something and go down something after a certain period, then again whenever it has 27 it can again go up to something, go down something. Then like that you can find out each node the probability, then if each node you can find out the probability, then find out you can the backward calculation you can make, and finally, the f can be calculated from that. So, that is the way basically the price of the option can be calculated using the binomial tree model. Then if you see in this context, we can have another model, we have the Black-Scholes model, and in the Black-Scholes model it is basically developed by Fisher, Black and Scholes and Robert Merton in 1973. And here the assumption is basically they have taken that the option is the European option and the underlying stock does not pay any dividend. Then the asset prices is continuous and distributed log normally. Taxes and transaction cost are absent. The restrictions on or penalties for short selling, there is no point of short selling here, no short selling is allowed, and risk free rate of interest is constant or also known to us, and there is no arbitrage opportunity exists in the market. These are the assumptions what the Black-Scholes model has taken. So, now what is our objective? Our objective is to see that it needs lot of derivations in terms of log normal distributions, then your distribution in terms of the option prices, the process like Ito's lemma, generalized linear process and all kinds of thing. So, this is basically beyond the scope of this, but here using these assumptions what this Black-Scholes basically has taken, that general Brownian motion, this generalized Wiener process, then we have the Ito's lemma, all kind of concepts are used because those things are depends upon the properties of that particular underlying asset and as well as the options, how they are going to be distributed over the time. So, we are not discussing those things, but using these assumptions basically Black-Scholes was trying to find out what are those factors which are affecting the call option. And here they said that the call the price basically determined by the market price of the asset, price of the option, exercise price of the option, time to maturity, market interest rate or the risk-free rate of return, and the volatility of the asset prices. These are the factors which are affecting the price of the call option. So, now what basically you can do, if you see that this is the formula what basically Black-Scholes has derived, that C is equal to, this is your price of the underlying asset S and D 1 minus k to the power minus R t and D 2, that is for the call option. For the put option is equal to, it is reverse, it is k means it is the strike price, k to the power minus R t n minus D 2 minus S and minus D 1. Now, what you can do, your D 1 is equal to, if you D 1 also it has been derived, D 1 is equal to log of S by k plus R per R plus R is equal to rate of interest, sigma square basically the standard deviation or the volatility of the stock or for any underlying asset divided by 2 to t divided by sigma root of t, t is equal to the time period. Then D 2 is equal to D 1 minus sigma root of t. So, here there are notations, C is equal to price of call option, K is equal to strike price, R is equal to risk free rate, S is equal to current price of the stock, time t is equal to time to maturity, ND1 and ND2 as the normal distribution of D1 and D2, and your sigma is equal to standard deviation or volatility of the stock. So, these are the notations and this is the formula. So, if you see this example, let there is a non-dividend paying stock, current market price is 52, underlying asset of an option of maturity 6 months, strike price is 50. If the risk free rate of interest is 10% per annum and volatility is 20%, then determine the price of the call option and the put option. So, now your S is equal to or S 0 is equal to 52, K is equal to 50, R is equal to 10%, sigma is equal to 20%, T is equal to 0.5 because it is 6 months. Then you can find your D2, D1 values, already you can put this formula ln 52 by 50 plus 0.1 into 0.2 square divided by 2 to the power 0.5 divided by 0.2 root of t, that is 0.5, then you find out 0.7015. Then your dt is equal to 0.7015 minus 0.141, it is basically your root of sigma into root of t, then it is 0.560. Then you can go to the table, normal distribution table of D1 and D2, you can find out ND1 0.758, ND2 is equal to 0.712. Then you can also use Excel for calculating this norms DIST function for this value of D1 and D2. Then C is equal to already formula the call option, you know that there is S into what, S into ND1 minus K e to the power minus RT into your ND2, then you can find out 5.56. The call option in this particular case is 5.56. Similarly, you can putting these values, you can find out the put option, and here your put option price is 1.12. So, this is the way the Black-Scholes model has been derived or has been used. So, although the derivation is very lengthy, but if anybody wants to go through that, you can go through any books on derivatives like Hall and other books which talks about the derivation of this particular formula, which is used for the valuation of the options. Then we have another instrument called the swap. Already we discussed about the swap. Swap is nothing but it is a kind of instrument which is used to transact in terms of the cash flows in the periodical manner. So, here we have two types of major swaps always we come across, one is your interest rate swap and another one is the currency swap. So, if a company agrees to pay cash flows equal to interest at a predetermined fixed rate on a notional principal, and in return it receives the interest at a floating rate on some same principal for the same time period of or same period of time, then we can call that this is basically the interest rate swap. Then why these swaps are used? The swaps are basically used to transform the nature of the assets and liabilities. We will see this example, then it will be more clear for you that how the swap is used. Let there is a 3-year swap started on 15 March 2012 between the companies let ABC and XYZ. Company ABC agrees to pay an interest rate of 7% per annum on a principal of 100 crore, and in return XYZ agrees to pay ABC the 6 months LIBOR rate on the same principal. And you see ABC is basically going for the fixed rate, that is 7%, and XYZ agrees to pay 6 months LIBOR rate on the same principal, and here the principal is not exchanged, that is why we call it is a notional principal amount. So, this is basically floating and this is fixed. So, that is why ABC is a fixed player and XYZ is a floating player in this case, because XYZ is paying on the basis of the floating rate interest and ABC is paying on the basis of the fixed rate interest. So, now you see that what is basically how the cash flow basically here looks like. If you see the cash flow to the ABC, because this is basically a 3 years contract, if the 3 years contract, then you have the 6 cash flows started in March 15, 2012, then 6 months LIBOR rates, let assume these are the LIBOR rates which are given, So, therefore, the floating rate cash flow, what is the cash flow to the ABC first? You can, if you see, cash flow to the ABC basically will be getting, because ABC is getting cash flow on the floating rate basis and paying the cash flow on the fixed rate basis. So, in the March 15, it is basically they are getting the 6% of the total money, that is 3, there is 3.1 on the basis of this interest rate. These are the interest rates. So, these are the cash flow what basically they will be receiving, and these are calculated on the basis of the principal amount. That means, here on the 6 months 6% interest, that means 100 crore, that means 6 crore divided by 2 3 crore, then it is 6.2 3.1 crore, then 7.4 6.7 crore, 7.8. So, like that they will be getting 7.5 3.75 3.94, like that they will get the cash flow what they will be receiving. And how much they are paying? They are paying, it is fixed because that is 7% interest. So, they are every 6 months they will be paying 3.5 3.5 3.5. So, the net cash flow if you see, then end of the day the net cash flow is positive, that is 0.50 for the company ABC. Now, if you see in this context how it is basically working, or we can say that how it is helping these two companies who are within basically going for this kind of swap contract. So, now you assume the ABC, for ABC the swap may be used to transform a floating rate loan into a fixed rate loan. What does it mean? Let the company ABC has borrowed 100 crore at LIBOR plus 20 basis point from outside, from any financial institutions. They have a borrowed amount and their obligation is 600 crore, and that rate is LIBOR plus 20 basis point. So, after entering this cash flow, then how basically it is converted? Let this is XYZ and this is your ABC. So, now what is happening? ABC is already paying LIBOR plus 0.2% to some outsider, he is paying, and now what he is doing? It pays LIBOR plus 2% to the outsider, it receives LIBOR from the XYZ, because XYZ is paying on the basis of the LIBOR. Then he is paying 7% to XYZ. So, if that is the case, then finally the LIBOR will be cancelled out. Then what is finally is happening? That previously it has a floating rate loan. Now, whenever they have entered into the swap, the floating rate loan becomes a fixed rate loan of 7.2% for ABC. So, let ABC wanted that they want to pay in the fixed rate basis, then that particular loan has become 7.2% after they have entered into the swap. So, the same thing can also happen XYZ. Let XYZ is paying on a fixed rate and they want to go for a floating rate, they want to convert their fixed rate loan into floating rate. Then here if you observe also, there is, if you see, they are paying 7.3%, getting 7%, and then what is happening? They are paying LIBOR, then finally what is happening? It is LIBOR plus 0.3% basically what finally they will be paying. So, that means their fixed rate loan has been converted into the floating rate loan. So, this is because of that this particular thing can be converted from the fixed to floating or floating to fixed once they have entered into the swap. The same thing, it pays 7.3% to the outsider, pays LIBOR, it receives 7% under the terms of swap. This arrangement makes the fixed rate loan to the floating rate, that is basically LIBOR plus 0.3%. 7% cancel, you will get LIBOR plus 0.3%. So, that is basically the conversion of the fixed rate to LIBOR plus 0.3% floating rate. This is the way the swaps are used in the market. Then you have the currency swap. It involves the exchanging principal and interest payments in one currency for principal and interest payment in another. The principal amount in each currency are usually exchanged at the beginning, at the end of the life of the swap. So, if you take this example, there is a swap between company PQR in US and TUB in UK, enter into the swap contract in February 15, 2012. So, it is basically fixed versus fixed currency swap. We have taken this example. Interest payments are made in a year, principal amount is $20 million and $10 million. PQR pays 20 million and receives $10 million and receives 10 million pound. Then how the cash flow to the PQR looks like? It will be, in the beginning they have paid $20, that means minus 20, and the positive, basically they have paid this much, they received this much. So, then on the basis of the interest rate, the 6% and 8% interest what we have considered, on the basis of that, this is the cash flow for the dollar cash flow, and this is the pound cash flow which can happen to the company PQR. So, here if you see, in the beginning it is the principal amount is transacted, in the end also it is transacted in that particular cash flow statement. So, this is what basically the basic idea about the concept of the pricing of the options and the use of the swap in the market, and these are the references what basically you can use for this particular session. Thank you.